What is a market? Why does it exist? And what is trading? So first of all, a market is simply a platform for buying and selling an asset. It can be any asset. It can be a stock. It can be a commodity like wheat or corn. It can be forex. It can be currencies. It can be crypto like you're here for and like we're going to talk about. They're all the same. It's just a collection of buyers and sellers. It's a place for them to meet and to decide on the price of whatever they're buying or selling. So why does it exist? There are a lot of misconceptions about markets. But if markets didn't exist, and this is why they're an essential function for the economy, if they didn't exist, companies wouldn't be able to raise capital for new investment outside of a very limited scope. And that goes for stocks as well as even crypto. Most crypto coins have a company or team behind them who are building something, and to get compensated for that, they need to have investment on the open market. And so it allows companies or teams to raise capital for investment. And in exchange for them offering these tokens or these coins to the market for me and you to buy, we buy that to speculate on the future performance. So either us as retail traders or institutions will speculate. If we like the team, if we have reasons to believe that the price will go up in future, we will buy. And we'll, at the start, typically be buying from the team who have worked from day one with very little compensation and are getting rewarded by listing their coin, their token, their stock, their asset, whatever. And also, markets exist for what's called price discovery, which just simply means the market is a better determinant of what the fair value or the true value of an asset should be. Instead of a government or a company saying this share is worth X amount, this coin is worth X amount, we put it into an open market where buyers and sellers can decide. It's supposed to be the freest and fairest way of deciding value. So within that, what we do is trading, and all we're trying to do through whatever analysis method, through whatever reasoning that we choose, and I'll show you many of them here, we are simply buying and selling assets with the goal of making a profit through changes in the price. That's it. Nothing more, nothing less. Trading is as simple as that. Doesn't mean it's easy, but it is in its purest form. That is all that trading is. So now let's jump into more in depth, get into the weeds, and talk a little bit more about how you actually trade. Let's talk about trading versus investing. What is the difference? So in the real world, we have multiple crypto campuses, two of which are the trading campus and the investing campus. Professor Adam runs the investing campus, I run the trading campus. And there might be some confusion as there are some terms that are used across both campuses that are similar. So let me explain. The main differences that I see between the two campuses are how active they are and the approach you take to trading. So trading, as I teach it, is much more active. You will be constantly monitoring the market and making many decisions. So it is more time intensive. It is something that you will have to do on an everyday basis generally. Whether you're actually trading every day, you will be analyzing and studying the market every day. Whereas investing is building some systems to be more passive, which you can typically buy and hold for more extended periods of time and make fewer decisions, which leads into the frequency of trading. In trading, you will make many, many trades, more frequent, multiple trades per day, week, or month. And investing, again, it's about buying and holding coins for extended periods and capturing the bigger moves. The approach, trading, this is the main difference between the two campuses, in my opinion. In trading, I teach price action and technical analysis using a combination of charts, indicators, patterns, and other data to make decisions on how to enter and exit trades. In the investing campus, you learn trend following strategies to manage your portfolio and catch the big swings. So the investing campus focuses on trend following, whereas in trading, we focus on all aspects of the market, up and down, trend following, as well as mean reversion, things that you will learn later on as you go through the lessons. Finally, the risk and reward. Trading is riskier. You are taking more trades, you are making more decisions. That opens up the opportunity for more things to go wrong. And so it has a greater potential for volatility. But if it's done right, it allows for a faster compounding of wealth. Investing is lower risk and seeks more stable, long-term returns. And yes, you can do both. You do not have to choose between the two. We have many students that manage the majority of their portfolio using Adam's teachings, and they also trade in order to supplement that to make some more profit on top so they can reinvest into more coins. That's the difference between trading and investing from the real world perspective. But if you look at it from the market's perspective, why do you trade? This is a very important question. You trade to try and outperform some type of benchmark. Okay. So this is Bitcoin. This is Bitcoin in the 2019 to 2021 bull run. And so from the very bottom of the bear market in 2019 to the top of the 2021 bull market, Bitcoin returned 18x total returns. Okay. So that would be what they would call hodling, where you buy and hold for that entire period. Hypothetically, you would make that much. When we trade, we are trying to outperform that. That's the whole purpose for trading. Okay, so that was 18x. Now let's look at a very simplistic example of the same time frame, the 2019 to 2021 bull run, taking just 3 trades. If you caught the very bottom all the way up to the top of this first move in a long, you then shorted the next move down, and you longed the next move to the top, the cumulative returns through compounding of those 3 winning trades would be 60x. So you boost your returns from 18x to 60x. Now, yes, this is a simplistic example. You're not expected to catch the very, very bottom, very, very top of every move. But the same principle applies whether you're trading over a full bull run or even just over a month. If you go in on a month-to-month basis, and let's say you're looking at it in January, at the end of January, if Bitcoin was up 10% and your portfolio from trading was up 20%, you have outperformed the benchmark, which is Bitcoin, and therefore you're a successful trader. If Bitcoin goes up 10% and your trading portfolio goes up 4%, you would have been better off just holding Bitcoin, and therefore you were underperforming as a trader. So to keep it very simple, that's the entire point. That's what you're here to do. That's what I'm here to teach you. I'm here to teach you how to get greater returns than just holding the benchmark itself.